Typically, financial advisors would suggest a 60-40 portfolio split, stocks and bonds, but some say that needs to change. David Picton is the CEO and president of Picton Investments. He joins us now in-house to talk about this. Thanks for joining us today.
Pleasure to be here.
You say we need to reconfigure the way we look at our investments. Why is that?
We think the single biggest way to improve investor outcomes is to focus on portfolio construction. There's not enough attention or detail paid to it. For the last 40 years, the traditional 60-40 model has had an outstanding run. It started with interest rates extremely high and stock prices extremely low. It benefited from inflation trends that all went down. And now here we are 40 years later, and we have stock prices extremely high, bond yields low and maybe on the way up, and in disinflationary trends ending. In that backdrop, we want people to move from 60-40, stocks and bonds, to something that's more like 40-30-30, stocks, bonds, and alternatives that are maybe not related to your stock and bond portfolio.
For example?
Well, at our firm, we focus on liquid alternatives, things like market neutral or alpha-driven strategies. We're trying to look on stock selection and how it can add value, and we want to build a portfolio so that it does not move in conjunction with the stock market. It does not move in conjunction with the bond market. It is a separate, kind of look at it as a third return stream. And if you can combine return streams that act differently over time, bring a diversification benefit to it, and if they all add some value, you will have better outcomes.
Do you think Canadians are being more defensive at this point in time than Americans are?
Alternative investments within Canadian portfolios are woefully underrepresented compared to almost all developed countries. There's reasons for that. It might be that we've been more traditionally based. There's been some barriers that have been put in the way. And so we look at portfolios and see really an underrepresentation in an area that we think should be more overrepresented.
For example?
Again, going back to these alpha-driven strategies that take you away from what's happening in the equity market and what's happening in the bond market. And the other thing to consider is that we've gone through an environment where certainty and globalization has really been your friend. And we're now into an environment where uncertainty, deglobalization, and of course our friends south of the border are changing the dynamics. If we ever got to an environment where people start questioning the U.S. as a reserve currency or the rule of law in the U.S. even, it's going to have dramatic implications for portfolios. And I don't think we've done enough time preparing for that.
Are we not already there?
We are there, but we don't think the markets reflect that. You know, we started the year with kind of 4 pillars as to why stocks should be, could maybe continue in their bubble-like phase. And one by one, we've knocked them down, especially around certainty and confidence.
As you know, the U.S. Fed makes an announcement tomorrow. We had U.S. retail numbers out today that showed another drop, but it was mostly in vehicles, which people were buying ahead of time because they were worried about the tariffs. What's your read on the retail numbers, and what do you expect from the Fed?
I think we're in a slowing trend. In other words, the U.S. economy has defied all forecasts about a pullback. Yet there's a whole bunch of things that are stacking up against them. There is less confidence and certainty. There is inflationary pressures building from tariffs. There's not really a good valuation argument to be made. And we don't have a Fed that's particularly friendly to equity prices at this point in time. So we've had this incredible recovery as some of the worst of the policies have been removed. But it's not like we're starting at a really good risk-reward opportunity either.
The Fed has said they want clarity. You don't think they're seeing that yet?
It's very difficult to have clarity when you have a one-man show that kind of comes out of left field and makes up policy on the way without giving it a whole lot of thought. So no, it's very hard for them to have clarity, just like it is for any other investor out there today.
Let's talk about the fact that you have rebranded recently. Tell me what brought that about, and also tell me about your mascot, which is, I would say most people say it's kind of an odd choice because it's a bear.
For 20 years at Picton, we've been trying to improve our capabilities around alternatives. We think we've grown into one of Canada's leading supplier of these strategies. We've invested in technology. We've invested in our team getting it stronger. We've invested in best-in-class risk processes. We're ready to make a statement. And so now it's time to invest in our marketing and our brand image. We want to send a clear message to investors that there are better ways to meet your goals with more certainty. And so to do that, you have to evoke an emotional response.
That would do it right there.
And we did.
Yeah.
And we've taken the idea of the bear, which used to represent fear, and we want that bear to now represent resiliency, strength, adaptability, to turn it into a symbol for preparation so that when we have the inevitable downs in portfolios, people have some resiliency built in. So they can withstand and they can hold on to their assets for longer and not panic out at just absolutely the worst times. So, and ironically, when we went through all of our analysis, and our marketing team did a fantastic job on this, the bear became almost a perfect vehicle to send that message, to elicit some emotion, and hopefully to build better preparation into portfolios.
Very quickly, the idea of a friendly bear, was that one person's idea or was that a team approach?
There was a bunch of people involved in it, and I think we're all pretty excited about how it's turned out on our rebrand.